Welcome to the Investor Coaching Show. Here's your host, Paul Winkler.
And welcome. This is the Investor Coaching Show. Paul Winkler. This hour joined by Mr. Jim Wood.
Hello.
All right. Ready for the brilliance. It's all on you, man.
Somebody else coming?
Oh, my pen fell apart. That's no... What? Oh, man. They just don't make pens like they used to. All right. The only thing that bothers me is my name's on it. That really bothers. You got a pen, and it falls apart with your name on it. That just doesn't bode well for the rest of the show.
I also have a pen with your name on it.
And that's not falling apart, though.
But it's working, so...
Yeah, so that's good. Okay, I feel better already.
Decent batting average.
All right, that's good. And there's a pencil over on the other side, and I think it's still working. Okay, so, Jim, what's going on? What would you like to talk about in this particular hour? Start off anyway.
Well, there's, lots of good topics and stuff out there, but I did run across an article on financial tips for couples getting remarried in their retirement.
Which is very different because you hear about gray divorce and you hear just the opposite.
Right. We've definitely talked about, how you're splitting up finances and stuff like this, but, people get married later in life. They've got a really long financial history and trying to blend those two. And what I've seen in planning is that there's really no rules of thumb or anything. Everybody does it differently. But I just thought this might be an interesting topic to discuss a bit.
Okay, so some of the things, I already have things that go through my mind based on situations that I've run into in my career, doing this. Well, what are some of the things that you thought were interesting and that we might add to?
Well, certainly it starts out, and this article was by a guy named Lyle Solomon in Advisor Perspectives. And just, one of the things, just making a list, a priority list, and just the main message to me here is you got to communicate about this stuff. You have to talk about it. And, and money's sometimes a touchy subject. And I think some of the main things, and one of the first points and stuff I think is really solid, was find out how much debt everybody has.
Oh, well, that's the same thing in marriage in the first place.
Yeah, absolutely.
We see that a lot. Somebody comes into something and they have no idea, and they walk into a marriage where somebody has some severe financial issues, and then that can cause some real problems and headaches down the line because one is a spender and one's a saver.
Yeah, and there was a corollary here, review credit reports, and that's kind of an awkward conversation. Oh, I love you, honey. May I see your credit report?
But I cannot. I'm having a hard time imagining that one.
Yeah.
But there is. It's interesting because there are a lot of different types of things that you can go through. People go through premarital counseling, but there's one called Prepare and Rich, and it actually goes through what is your philosophy on finance. In it, that's one of the subcategories. So, I would think, just based on what I know about it, having gone and actually gotten certified in it myself, I think that would be a really good thing for people to go through before they ever get married, because it talks about hobbies. What are your hobbies? What are things that you like to do? Are they things that you have in common with each other? What is your philosophy on different aspects of life? But I just want to focus in mainly on finance because that's what this is, a financial show. But it talks about that. What is your idea of success? What are you looking for as far as where do you want to live? What kind of lifestyle do you want to live? What is your attitude toward debt? What is your attitude toward making sure that you don't miss payments on things and that you're financially literate? And that is a big part of it, because once you see areas like that, it actually tells you, hey, this is an area that you might want to work on. It doesn't, knock you down. It just says this is an area for focus. And a lot of times what happens, people grow up with attitudes about finance that come from, when they're kids, and maybe they saw nothing but profligate spending when they were little kids. And they saw that their parents were trying to win the approval of other people through their spending. And some people rebel against that. Some people embrace it. Go, oh, that's how you win friends. You spend lots of money. That's how you get, people around you and that support you, is you go out and buy whenever you're going out to dinner. That's how you make yourself look good. That's how you show that you have status. You buy. And that is something that you want to see before you get into the marriage. You want to see whether you both have the same attitudes on those types of things.
Yeah, and it comes down to investment philosophy. Is somebody like, well, I want to be aggressive, or I want to, sometimes it's doing, somebody wants to do some crazy stuff,
Oh,
like
that's another good
gamble
example.
and speculate.
Yeah, and that's another good example is, what is risk? It was, the one of the things I've been talking about lately is, and it was just so much fun going and teaching kids. I can't say kids, college age students, last week. But basically what I did was I said, hey, let's define risk, because most people think that risk is what? The risk that, and then the kids answered that you'll lose everything. I said, beautiful, perfect. That's not the way we define risk. It's just fluctuation in value. But a lot of times people come away with the idea that risk is that I could lose everything, when they don't recognize that the way an academic would actually look at this is just the fluctuation, how much fluctuation there will be. And the more that you can put up with, the higher the expected return normally. Sometimes some types of risk are uncompensated. But basically what happens is you can have fluctuations, and if you have a long period of time, it's no big deal. You look at it and go, yeah, so what? I deal with fluctuations. I could go, a long period of time with no return and then have quadruple the normal return that you normally see in a very, very short period of time. So that's defining that risk and making sure that both people are on the same page. I think that's where the planner can really be helpful.
Absolutely. And one of the things in terms of who pays for what is a big deal, right? 'Cause,
sure.
Every situation is different. You might have two more or less equal incomes. You might have one income that's high and one that's either low or even non-existent. So, figuring out who's going to pay for what. And I really see a broad spectrum coming across with how people handle that. Some people just like, okay, everything's separate. I pay the mortgage and they pay the other bills, but we keep separate bank accounts. We keep, that. And there's people that are just the opposite. Say, well, we're getting married. Everything should be blended and that type of thing. But it's the key there, of course, is making sure everybody understands it and good with it. So you're not building up any long-term resentment about anything.
Well, and that can be, especially with the heirs, that can be an issue. If one person comes into the marriage with significantly more, and then all of a sudden, all of their stuff ends up going to their kids from a previous marriage, let's say, and then the other one has the kids from their previous marriage who end up not having enough or not getting enough or getting much less than they would have had the marriage not happen. And that's particularly the higher person, the higher income earning and higher asset.
And that was actually one of the areas that this article went to is, of course, estate planning. And it's crucial. And I'm talking about, one of the ways to handle a lot of these questions is a prenuptial agreement. And so everybody sits down and decides, okay, this is what we want to happen. This is what we agree to, that type of thing. And it has to be done before marriage because state laws don't usually accept post-nuptial agreements. So you have to get this stuff in place there. And
because you would only do it after the marriage was in trouble, right?
Yeah.
Yeah.
And then, of course, making sure your beneficiaries are correct or certainly updated. And that's something everybody needs to do, getting married, not getting married, whatever, is always know who your beneficiaries are and if they're correct. And if they're not, check those, find out, update them. Because time and time again, somebody can, pass away and it goes to a former spouse instead of the current spouse, those types of things. Or if you have multiple sets of kids of different families, you want it to happen as you want, not something that you thought about 10 years ago, but haven't updated.
Right. So one of the things I had run into was, I'll never forget this. I had a couple that actually, they both worked with me from a financial side standpoint. And it was interesting. They did not meet at a workshop, but they actually ended up getting married. And it was fascinating because what happened was that one of them had a very substantial work history. The other one did not. So the one that did not had a very low Social Security benefit. And one of the things that ended up happening is they ended up getting married, and he ended up passing away, and she ended up getting his Social Security benefit. And that was one of the benefits of it. They had to it had to be a 1 year, 9 months, I think it is, as I recall. There was 9 months. You had to be married for at least 9 months before that would actually work. Or if there was an accidental death, it didn't matter. But and something happened accidentally 3 months later, the spouse that had the lower benefit, if the person that got killed in the accident was the higher Social Security spouse, the lower one ended up getting their benefit for the rest of their life, and it literally saved her back end.
Yeah,
quite frankly.
Yeah, that's that benefit of getting the highest of the two. I mean, some people kind of go into it thinking like, okay, I have this amount, and that's going to last forever, but they're not always aware of how that works. That you do lose the lowest of the two benefits, and so and that's one of the arguments for the higher earning spouse to delay their benefits as long as possible to maximize that.
That's a really good point. Yes, especially if you have a situation where you look at both people and say one of you is probably going to be around for a lot longer, a lot of times, than the other. Sometimes they both pass around the same period of time, like my parents. But for a lot of people, you take a joint life expectancy for somebody in their 60s, a couple in their 60s, and one of them, the very, very high likelihood they'll be around in their 90s, now. So that's one of the things to keep in mind as we deal with this. But anyway, so what else did they come up with? I'm interested to hear other types of issues that they came up with.
Yeah, well, certainly the different assets that are out there and kind of knowing who has what and how they're invested and how that impacts the marriage. So just, your retirement accounts, again, how are those invested? What's the plan in terms of taking income? Are you planning on doing any big purchases, down the road? Those types of things. What type of, do you use credit cards? Do you pay them off? What other...
Let's go back to the assets thing. Just simply because I've seen this before where one is a lot more aggressive than the other and then has it more aggressively managed. And then you all of a sudden have a market downturn and now they have to turn to the person with the less, let's say if you have somebody that is, when I say aggressive, let me define that first, because it's probably important to define what aggressive is. You can have aggressive where you're taking risks that you're not paid to take. Like, let's say we look at Bitcoin, as I talked about last hour. If you look at that and go, are you taking risk? Yup. Are you expected to get rewarded for that risk? Nope. If you gold, you look at, speculative investments, options contracts and things like that. You're taking all kinds of risk you're not expected to get paid for, other derivatives and things like that. But what happens is that if you have an investment portfolio, let's say that you're taking the proper types of risk. You're on the efficient frontier, as Markowitz put it, the guy that won the Nobel Prize in 1990, basically said, we can maximize expected return for a given level of risk by putting things together that historically don't move in similar fashion. So the idea is that diversification, you're diversifying prudently, in other words. Now you have this investment portfolio, and you might have different time horizons. If you're all stocks, 100% stocks, you might have a 10-year time horizon. In other words, you could go 10 years with no return, even in a well-diversified portfolio. Then you, let's say, have the other person is in a portfolio that's half stocks, half bonds, and that is a 3 to 5 year time horizon. And then you might have 60-40 somewhere in between. But basically, you're taking an income from a portfolio, let's say that is all stocks, which works wonderfully well if the market's going up. But all of a sudden, you have two people that are in two different risk categories. One's super, super aggressive, all stock. The other one is, let's say, half stocks, half bonds. And all of a sudden, you go into a market downturn, and we're going, honey, can we pull money from your portfolio? Because my all stock portfolio isn't doing so well. And, and then all of a sudden, now you've unevened the potential inheritance for the other spouse that was more prudently managed. So I want to spend some time on that because I think that that's important, is making sure that you have a handle on the level of volatility for both portfolios, because it could make you unduly dependent upon the other spouse when things go wrong.
And, kind of a corollary to what you're talking about too is in terms of the risk they're taking is their knowledge. And some people insist that they're very knowledgeable, but they're, trading individual stocks. They're chasing,
Delusionally knowledgeable.
Right, exactly. But they're confident in their lack of knowledge.
Yeah. Well, and I want to hit the other side as you were talking and made me think, well, there's the other side of that too. Let's say that you have somebody that is, 60% stocks, 40% fixed income, well-managed, prudent portfolio, let's say, just to make that assumption. And the other one's just, I'm so scared. And they have all their money in cash. And all of a sudden, the other scenario happens where you become overly dependent upon the person that had some stocks because of inflation. You've basically deflated away the value of the fixed income portfolio, where the fixed income portfolio maybe looked great when you first retired, but it looks like nothing because of inflation, because cost of living's gone up by 10 times, and you can have the other thing happen, the other side happen. So I could see where it would happen both ways. So I think that's a really important part of the conversation that I didn't think we should just gloss over. I think that's so important.
Sounds good. And I'll add one other thing too, is that if there are either kids or parents, because, you get to that retirement age of maybe early 60s or something, there's always a possibility for some kids out there that are still dependent on the parents. I mean, it's unfortunate, but I've seen it.
What a good point. I mean, really, yeah, because that can create all kinds of stress, because the one that doesn't have that issue, they have kids that are out there, they're taking care of themselves, they're independent, can become very resentful when the other spouse has kids that are constantly dependent upon them, and that can create all kinds of tension and arguments.
Yeah, and the other part of that is, of course, parents. There can still be parents with health issues that may need some type of help, support, time, those types of things too. And again, it really comes back to communication about all this stuff and making sure everybody understands the other one's feelings and how to potentially deal with this, so it's not the landmine somewhere down the road that trips up the whole marriage.
And that's one of the things that I think is incumbent upon the financial advisor to actually bring up some of these points, because you're not going to think of this stuff. And the advisor should be going, hey, yeah, okay, let me tell you some things that are potentially problems down the road, because if we can diffuse them now and talk about them now, if and when they occur, they're not so catastrophic. But if they're surprises, watch out. That can be a real problem.